Welcome back to the Daily Crypto Roundup. It's Thursday, November 6th, 2025. And today's session has the market taking a slow, steady breath after a turbulent week. Volatility has eased, investors are refocusing on fundamentals, and for the first time in days, sentiment feels calm rather than cautious. Here's what we're covering today. JPMorgan has just released a striking new projection for Bitcoin's next 12 months, a target that's raised eyebrows even among the bulls. We'll also look at what analysts are calling a liquidity drought in digital assets, and how that fits with Tom Lee's claim that headwinds may soon flip to tailwinds. From there, we'll turn to a surprising pivot in the mining world as Cango doubles down on Bitcoin infrastructure and AI, and then, after the break, dive into the big structural stories: Robinhood's global crypto expansion plan, the White House's bipartisan regulation push, the UAE's rise as a trillion-dollar digital asset hub, and a global survey showing that hedge funds have never been more invested in crypto. Bitcoin is trading just above $101,000, consolidating after yesterday's dip toward the psychological $100,000 level. Ethereum sits near $3,330, still holding its range despite thinner liquidity. BNB trades around $944, Solana at roughly $157, and XRP steady near $2.24. Dogecoin changes hands around 16 cents, Cardano near 53 cents, Tron at 28 cents, Avalanche close to $16, and Chainlink around $14.60. A mixed session overall. But compared to the sharp swings earlier in the week, this feels like stability. JPMorgan's forecast is where we begin. Their research team has put out a new note estimating that Bitcoin could climb as high as $170,000 within the next 6 to 12 months. It's a bold number, but the reasoning isn't about hype. It's about math. The bank applied its volatility-adjusted gold model, the same framework it uses to track long-term fair value in commodities. Analysts say Bitcoin is beginning to behave like a reserve hedge asset with higher beta, meaning it still moves faster than gold, but increasingly in the same direction. That, in their view, justifies a multi-quarter re-rating higher. They also pointed to ETF flows as the structural driver. Institutional funds are continuing to rebalance into Bitcoin despite the recent dip, treating it as a long-duration play rather than a speculative trade. JPMorgan's conclusion was clear. Unless global liquidity contracts further, the probability of another sustained leg higher outweighs the risk of a breakdown. It's not a forecast for tomorrow. It's the shape of a thesis that assumes Bitcoin continues maturing into the financial system's alternative collateral. That ties neatly into the next point, because while price models are turning optimistic, on-chain liquidity tells a different story. A new report from CoinDesk's Daybook describes how fresh inflows into crypto have slowed to a trickle. There's rotation, yes, but little new money entering the space. Analysts call it the liquidity desert. Existing holders are trading among themselves while institutional inflows wait for clearer macro signals. The total value locked across major DeFi platforms has stagnated for weeks, and exchange volumes are running at roughly half of their Q2 average. So how do we reconcile a bullish model with a dry liquidity backdrop? Tom Lee from Fundstrat offered a simple answer this morning. And that's macro pressure. His team argues that the sell-off wasn't driven by crypto-specific weakness, but by wider risk-off positioning across equities and bonds. Lee believes those headwinds, higher yields, a strong dollar, and geopolitical tension are already peaking. Markets move before the data, he said. And when macro stabilizes, crypto will lead the rebound. That view's shared by several trading desks, who now see Bitcoin's sub-$100,000 test as a shakeout rather than a structural breakdown. The common theme: leverage is lighter, funding rates have normalized, and that gives the market a cleaner base if momentum returns. One company betting that crypto's infrastructure phase is far from over is Cango, the Chinese auto transaction firm turned Bitcoin miner. In a surprise announcement, Cango said it's strengthening its mining operations and expanding into high-performance AI computing. The company plans to use existing data center capacity to provide HPC services for machine learning workloads while maintaining Bitcoin mining as its cash flow backbone. It's part of a broader trend where miners pivot toward AI to survive cyclical downturns and block rewards. If successful, it could mark a new hybrid business model: mining when profitable, compute leasing when not. It's a reminder that in this space, adaptability equals longevity. Mining has always been a margin game, and firms like Cango see diversification as the next stage of evolution. Less pure hash power, more computational utility. We'll take a short break here, and when we're back, we'll move from the miners to the markets that fund them. We'll look at Robinhood's 10-year crypto vision, the regulation bill gaining traction in Washington, and how the UAE's rise is rewriting the global crypto map. Stay with us.
Avoiding your unfinished home projects because you're not sure where to start? Thumbtack knows homes, so you don't have to. Don't know the difference between matte paint finish and satin? Or what that clunking sound from your dryer is? With Thumbtack, you don't have to be a home pro. You just have to hire one. You can hire top-rated pros, see price estimates, and read reviews all on the app. Download Thumbtack today.
If the first half of today's episode was about survival and stability, this second half is about expansion. The companies and countries betting that crypto's next decade will be shaped by scale and policy rather than speculation. Robinhood is a perfect example. Once known for zero-commission stock trading, it's now positioning itself as a global digital asset platform. Executives confirmed this week that crypto will be a cornerstone of the company's long-term strategy. They're exploring treasury exposure to stablecoins, potential ETF partnerships, and deeper integration of on-chain services. CEO Vlad Tenev described it as a 10-year horizon play, saying that Robinhood's goal is to become the most trusted retail gateway into digital finance. Their crypto revenues are already soaring, and with the firm's expansion into Europe and Asia, it's starting to look more like a fintech than a brokerage. Analysts say the move reflects a generational shift. Younger investors are more comfortable holding crypto than bonds, and platforms that meet them there will own the next decade of financial distribution. While the private sector expands, Washington is finally trying to catch up. A senior White House advisor told reporters this week that the long-discussed bipartisan crypto regulation bill has gained meaningful momentum in Congress. After years of partisan gridlock, both sides appear ready to codify digital asset definitions, stablecoin standards, and exchange oversight. The advisor described the discussions as constructive and increasingly pragmatic, hinting at a 2026 target for final passage. If it passes in anything close to its current form, the US would finally have a unified framework similar to Europe's MiCA, something markets have been demanding since the FTX collapse. Regulatory clarity doesn't always cause rallies, but it removes uncertainty, and that alone tends to attract capital. One place that proves regulation and growth can coexist is the United Arab Emirates. A new book, Arabian Crypto, details how the UAE transformed itself into a trillion-dollar digital asset hub in under 5 years. The country built transparent licensing regimes, invited global exchanges to set up shop, and integrated blockchain into everything from customs clearance to oil trading logistics. Dubai's Vara Authority now supervises one of the most active digital asset markets in the world. For comparison, analysts estimate that per capita crypto ownership in the UAE is roughly 3 times higher than the global average. It's a case study in controlled openness. Build the rules early, attract the innovators, and let capital follow. Western regulators are watching closely because the UAE model has become a magnet for institutional money that wants exposure without regulatory chaos. And speaking of institutions, that brings us to the final story. A new Reuters survey showing that more than half of global hedge funds now have crypto exposure. The average allocation sits around 7% of total assets, up sharply from last year's 47% participation rate. The reasons are telling: diversification, inflation hedging, and yield opportunities in tokenized debt markets. What's even more interesting is how that exposure is structured. A growing share of funds now use on-chain derivatives and wrapped asset ETFs rather than holding tokens directly. It's a sign that crypto's infrastructure has matured enough for mainstream risk management, and that the fear of custody or compliance is being replaced by the pursuit of performance. What's easy to miss in a day like this is how different the market's foundation feels compared to 2 or 3 years ago. Back then, a sell-off of this size would have triggered panic, mass liquidations, and Twitter chaos. Now it feels almost procedural, an adjustment within a broader uptrend that's being quietly shaped by regulation, infrastructure, and institutional positioning. You can see it in how money behaves. ETFs continue to attract steady inflows even on red days. Stablecoin supply, which serves as crypto's lifeblood, hasn't contracted meaningfully. And miners, the same ones that once struggled to stay solvent through volatility, are now balancing energy contracts, AI partnerships, and hedged exposure with a professionalism that didn't exist during the last cycle. Even the tone of market commentary has matured. Analysts talk less about moonshots and more about treasury management, yield differentials, and network security. What that tells you is that crypto's audience has changed. It's not just traders anymore. It's funds, corporates, and sovereign players looking for efficiency, transparency, and long-duration yield. If this cycle continues on its current trajectory, the conversation 6 months from now might not be about spot prices at all. It'll be about liquidity corridors, tokenized bonds, and the first major public institutions allocating directly on-chain. And if that happens, the next time we see a correction, it won't look like a crash. It'll look like rebalancing. That's the quiet transformation happening beneath the charts. The prices make the headlines, but the infrastructure decides the future. Put all these pieces together and the picture is clear. This isn't a market running on hype. It's one reorganizing itself for longevity. The speculative excess is fading, replaced by real capital, real products, and real policy. That's your Daily Crypto Roundup for November 6th. If you're listening on Spotify or Apple Podcasts, follow the show and leave a 5-star rating. It helps push independent crypto journalism up the charts. Drop your thoughts in the comments, and as always, we'll see you at the top.